Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. Let's take a look at the stories for the day. The Supreme Court on Monday nixed petitions challenging demonetization and upheld its legality. The verdict came over 6 years after the government demonetized 86% of cash in circulation in one go by declaring notes of Rs 500 and Rs 1000 illegal. So, what did the Apex Court actually say in its verdict? And what does it mean? Pashwar Kumar brings you the answers.
On the 8th of November 2016, Prime Minister Narendra Modi made a surprise TV appearance to announce the demonetization of 500 and 1000 rupee notes. What followed was nothing short of mayhem. Banks had never seen such large crowds at their gates, and people had never before spent so much time waiting outside banks either. While most people forgot about the ordeal, small industries and businesses that heavily relied on cash could not. The informal economy bore the maximum brunt. The shock of the decision is not likely to fade from memories anytime soon. Eventually, 58 petitions challenging the demonetization exercise reached the Supreme Court, with the hearing commencing in October of 2022. The Constitution Bench had reserved its verdict on the 7th of December. Finally, on the 2nd of January, the Apex Court upheld the demonetization decision, saying that it was an executive policy and could not be reversed. Rejecting the challenge posed by the 58 petitions to the decision, the 5-judge bench said that the government's decision-making process was not flawed. Authored by Justice B.R. Gavai, the verdict was agreed to by Justices S. Abdul Nazir, A. S. Bopanna, and V. Ramasubramaniam. The dissenting judgment was given by Justice B. V. Nagaratna, who faulted the note ban process but did not quash it. The majority said that the 52-day window provided for the exchange of demonetized currency notes with legal tenders was not unreasonable and could not be extended now. So, what did the majority judgment of the bench have to say? While delivering it, Justice Gavai said that the court could only exercise a limited judicial review in matters of economic policy. He added that there was prior consultation between the RBI and the government dating back 6 months prior to the date of the note ban announcement. Justice Gavai also said that the purpose of demonetization was proper and the exercise and time period allowed for currency exchange were not hit by the doctrine of proportionality. It was observed that during the 1978 demonetization exercise, the window of the exchange of demonetized banknotes had initially been 3 days, which was extended by another 5 days. In 2016, 52 days were given to the public. While stating that the demonetization decision did not suffer from any legal or constitutional flaws, the majority judgment also made 3 other key points. First, the central bank did not have any independent powers to extend the time period. Second, the government on its part had the authority to demonetize all series of banknotes, and this power was not limited to one series alone. And third, there was no excessive delegation of power by which the government commenced the note ban exercise through a notification in November 2016. Meanwhile, Justice Nagaratna differed with the majority judgment and said that it missed the main issue, which was that the central bank should have initiated the demonetization process and not the center. She said that as this process was reversed in 2016, the demonetization decision was legally flawed. Justice Nagaratna also pointed out that there was no independent application of mind by the RBI and the policy was brought in solely by the centre. However, the dissenting judge said that while the note ban process was illegal, it could not be reversed now. She differed from the majority about Section 26(2) of the RBI Act on the centre being able to demonetize any series of banknotes of any denomination. She also said that the Parliament should have discussed the law on demonetisation and it should not have been done by a Gazette notification. Challenging the demonetisation decision, the petitioners had contended that the procedure prescribed in Section 26(2) of the RBI Act 1934 was ignored. Appearing for one of the petitioners, senior advocate P. Chidambaram also argued that under Section 26(2), the government could not demonetize all series of notes of a denomination. He had urged the apex court to read down the provision so that the expression "any" contained within it would be read as "some." So, what does the SC verdict really mean? Business Standard consulting editor and banking sector expert Tamal Bandyopadhyay said that this case was about the constitutional validity of demonetization and not its outcome, which was an economic debate and not a legal one. He explained that Section 26 of the RBI Act deals with banknotes, adding that Section 26(2) stipulates that currency can be withdrawn or demonetized on the recommendation of the RBI Central Board and notified by the government. According to him, it also says any series of banknotes of any denominations can be demonetized. Bandyopadhyay explained that Chidambaram had flagged off the issue that demonetization was not done by the RBI board. Instead, it was a government move that the board ratified. In other words, it was not an RBI recommendation and the recommendation came from the government. He concluded that the SC judgment found nothing wrong in the government recommending demonetization and the RBI board clearing it before the Gazette notification. Also, the judgment treated any on a par with all, meaning the entire series of 500 and 1000 rupee currency notes were demonetized. Simply put, Bandyopadhyay said the SC upheld the constitutional validity of the move. Business Standard also reached out to legal experts to understand what the SC's verdict means.
The majority judgment did not come as a surprise. In the 1980s, there was what was called the bearer bonds case. Bearer bonds, which sort of legitimized a lot of people's black money. When that was challenged, the court even then said that no, in matters of economic wisdom, we do not sit in judgment over government policy. So to that extent, there is precedent to support it. A future government, if it ever were to think of demonetization, would have to grapple with also with what the minority said and said, maybe it is better that Parliament should be consulted in such matters.
It's a 4-1 and the law is well settled that the executives can exercise powers under 26(2) in the manner they have done. So Justice Nagaratna's judgment, I don't see much force going forward, except it says that the way to do it is through a primary legislation. It may only persuade the Supreme Court to take a different view in future, if at all.
Wiping out black money and creating a cashless economy were the rationale behind the note ban. But an RBI report in 2018 had said that over 99% of demonetized money had come back into the system. Cash also remains king in India, with RBI data showing that in October of 2022, currency with the public was almost 72% higher than the level seen in November 2016. Clearly, the demonetization debate isn't entirely settled.
If note ban put millions in the bank queues, pandemic forced many more to line up at railway stations and bus terminals. With jobs gone, they had no option but to return home. Struggle to feed their families followed. It was then that the government had launched Pradhan Mantri Garib Kalyan Anna Yojana to provide free food grain. And after about 2 years, the scheme has now been scrapped. But the government has made PDS free for 1 year. So, what will be its impact? Will it any way affect the government's fiscal planning? Tushar Verma has the answer.
The central government took two crucial decisions in one go last month. The first one was to scrap the Pradhan Mantri Garib Kalyan Anna Yojana or PMGKAY from January 2023. The scheme was introduced at the beginning of the pandemic and provided 5 kg of wheat or rice free of cost on top of already existing NFSA food aid, and it helped millions tide over the pandemic crisis. And the second big decision was to make food grain supplies under the National Food Security Act or NFSA free for 1 year. So for 1 year starting January 1, card holders under the NFSA will not need to make token payments. NFSA beneficiaries, which are Antyodaya Anna Yojana households and priority household persons, will receive 5 kg of grains free of cost now till the end of December. Earlier, the grains under NFSA were provided at a central issue price or CIP. There are about 810 million beneficiaries under NFSA. Since 2013, when NFSA was enacted, the central issue price has remained unchanged. It was Rs 3 per kg for rice, Rs 2 per kg for wheat, and Rs 1 per kg for coarse grains. Now that it has been made free, it is bound to impact the government exchequer. In 2022-23, the government procured 187.92 lakh metric tons or LMT of wheat, 407 LMT of paddy, and 279.59 LMT of rice. Along with procuring food grains, the government also maintains buffer stock in the scenario if procurement falls.
So there are two things to that. One, it helps the government in keeping with its own larger welfare of the society in mind. Secondly, it also helps the government to cut down on its wheat stocks and also the subsidy levels. Now, the question here is that the procurement will have to be continued at the earlier levels. Your subsidy levels will keep on increasing from here onwards, but it might not be as big as with the PMGKY, but it won't stop at 2.5 lakh crore. There is a problem with the grain stocks. Your wheat stocks, if the GKY was extended for another 3 months, would have fallen to a level which was not a very healthy, though it was still more than the buffer norms of March 31st, 2023, the wheat stocks, but it will still not be very healthy.
While the move to end PMGKAY and make NFSA free might have short-lived fiscal benefits, experts say the practice is unsustainable in the long run. In February 2022, the Central Finance Ministry estimated the food subsidy bill for FY23 at Rs 2.15 trillion. However, since PMGKAY was extended for the entire calendar year 2022, the estimated bill now is Rs 3.3 trillion. The good part is that with PMGKAY now completely out of the picture, the Finance Ministry can plan its expenditure in advance for FY24. For FY24, the food subsidy bill is expected to be Rs 2.1 trillion. For FY23, the total subsidy bill for the central government is estimated to be Rs 5.32 trillion. This includes subsidies for food, fertilizers and petroleum. Of the total subsidy, food subsidy makes up 54%. The move to end PMGKAY and make NFSA free will provide a saving of up to Rs 1.5 trillion. At the same time, foregoing revenue from NFSA will incur a loss in the range of Rs 10,000 to 15,000 crores. Although the decision of free food grain is only for 1 year, experts suggest that charging a price for something that has been made free is politically difficult. The government has set a fiscal deficit target of 6.4% of the GDP. It remains to be seen how this particular decision will impact fiscal consolidation.
So far this year, the estimate is that this year food subsidies already reached 3.3 lakh crore compared to a budget target of 2.07 lakh crore. Now the government says that the cost per year will be around 2 lakh crore. However, that may not be the case. It could be higher than that because the cost of procurement and the minimum support price which will increase every year. So while compared to the pandemic years, the government is saving money. However, compared to pre-pandemic times, this is still a sort of an increase because even the subsidized food has been removed. Now it's free for all the beneficiaries. So that is the fiscal impact of this move.
Meanwhile, elections are due in 9 states this year, and the centre's move may tempt other state governments to take similar steps. In December 2022, Business Standard reported that several states such as Jharkhand, Karnataka, Kerala, Tamil Nadu, and West Bengal used to further subsidize the food grains. In these states, beneficiaries received food grains free of cost and not on central issue price. With the centre subsidizing to make food grains free, states will save up quite a bit on their food subsidy bill. On the other hand, state governments will lose their political mileage since free food grain gave them an edge over the centre on political turf. Andhra Pradesh spent 40% of its total subsidy on food subsidy, while Kerala spent a whopping 86%. It remains to be seen how states will make up for the lost political asset with huge savings. However, states can still provide food subsidies for food not under NFSA. The NFSA only covers wheat, rice, and coarse grains. If states do resort to such subsidies, it will impact their fiscal consolidation.
There has been several instances and several state governments which, even though the central issue price under the NFSA which the central government is to give is very lower, they even used to subsidize even this 3 to 1 rupees and gave it completely free to the beneficiaries in their respective states. Now, with this one single step of the central government, this advantage which many states had, they stand to lose that advantage. The quantity advantage might not be there because the NFSA is just 5 kg per person per month, while there are states like Tamil Nadu which give you more than 5 kg per person per month. That the state will have to procure, but the price advantage which the states used to give as a welfare measure, that has in one stroke center has taken away.
Centre's decision to make food grain under NFSA is a well-calculated political and fiscal move. It robs away states' opportunity to make food grains free of cost and also reduces its food subsidy bill. However, in the long run, the practice is fiscally unsustainable. With a target deficit of 4.5% of GDP in the long run, the centre will have to eventually curb its subsidy bill. It remains to be seen how this decision will play out in 2023.
Moving on to markets, raw material prices are steadily continuing their downward journey, while a firm pickup in credit cycle has also boosted overall sentiment. Will these positive factors provide succor to India Inc.'s fortunes in the third quarter earnings of FY23? Lovisha Darad brings us a detailed report.
IT major Tata Consultancy Services will start the Q3 session next week on Monday. HCL Technologies, Infosys, Wipro and HDFC Bank will be the next in line to release their results during the week. This comes after India Inc. delivered a dismal bottom-line performance in the September quarter amid shrinking margins. Data shows that combined net profit of 2,725 listed companies across sectors declined 6.3% year-on-year in Q2 FY23, which was the first contraction after 8 quarters of growth, while the combined net sales of all listed companies rose 26% YOY in Q2 FY23. Analysts, however, expect the corporate sector's performance to have improved in Q3 as raw material prices eased due to falling commodity costs. Banking and financial services, construction and capital goods are likely to drive Q3 earnings, they believe.
The implication of this impressive growth in credit is that the Q3 results of the banking majors, all banking stocks, particularly the banking majors, will be very impressive. Already the asset quality of banks are at a decade high. Therefore, banks can be expected to continue their good performance of the last several quarters. The implication of the improvement in capex is that capital goods companies like Larsen & Toubro, Cummins, ABB and Thermax will come out with good results. The market can be expected to respond to these good results. Regarding the rebound in real estate and construction, apart from the real estate companies, all construction related companies in steel, cement, paints, adhesives, tiles, sanitary wares, all these segments will be delivering a good set of numbers. As far as IT is concerned, results will be okay on expected lines, but the market response would be decided by the management commentary regarding the future outlook. The segments which are likely to disappoint would be the two-wheeler segment of automobiles. FMCG is also likely to report the subpar numbers because their margins will be under pressure.
On the flip side, though the reversal in raw material prices is likely to provide respite to commodity-linked companies, it will continue to weigh on their margins, analysts say.
Discretionary items such as electronics, consumer durables, and appliances are expected to witness strong growth in demand in Q3 FY23. We are expecting retail chains and consumer durable appliances manufacturers to report stellar YoY performance in Q3 FY23. Commodity business such as metals, coal, mills, etc. are expected to disappoint due to the decline in global commodity prices, which could reduce their EBITDA per ton and impact their net earnings.
Meanwhile, at the Bosses, the S&P BSE Metal Index gained the most during the October-December quarter with a jump of over 15%. Banks, oil and gas, and capital goods indices, on the other hand, rose up to 10%. In comparison, the S&P BSE Sensex gained over 5% during this period. As regards today, global cues, rupee movement, foreign flows, and crude oil prices will continue to dictate market trends.
Inflation played a spoilsport for several sectors last year and pulled down their stock prices too. Consumers also felt the heat. Those at the bottom of the wealth pyramid were the worst hit. And it is one of the reasons that the government is now mulling shifting to living wage from the existing minimum wage. The living wage is indexed to inflation, and if implemented, it will give a big respite to those living on the margins. But what exactly is a living wage? We decode it for you.
The Minimum Wages Act came into effect on 15th March 1948. It gave statutory status to minimum wage that a worker is entitled for a day's work. Since labour is a concurrent subject, states too are free to decide the wage which should be higher than the floor fixed by the central government. Currently, the minimum wage in India is 178 rupees a day, but as the name suggests, it is the minimum wage guaranteed by the law. It differs from state to state. A recent RBI report revealed that while some states like Kerala pay as high as 837 rupees a day to a daily wage construction worker, states like Madhya Pradesh and Gujarat pay 267 rupees and 296 rupees a day for the same work. Kerala was on the top in the payment to agricultural and non-agricultural segments too. National average minimum agriculture daily wage was 323 rupees. Most would agree that 300 rupees a day is enough to meet the food expenses of a family. But what about other needs? What about education of children, medical bills of the family, etc.? According to a report in a national daily, the Labour Ministry is now mulling shifting to the system of living wages. Living wage is the minimum necessary income for a worker to meet their basic needs. Food, home and clothes are considered as the most basic needs here. Ideally, a living wage allows an individual to meet their basic needs solely from their employment without relying on government subsidies. The cost for the needs varies from place to place and the gravity of needs can change considering the time and context. In most cases, the living wage and minimum wage will have a difference of 10 to 25% based on the cost of living of a particular place. The living wage is sensitive to an individual's quality of life. It prioritizes the person and their need above the employer and their profit. It is claimed that adopting living wages against minimum wage will have profound psychological impact and workers will perform better in a living wage system. Also, minimum wage can push more people into poverty as a consequence of being unemployed. Living wage also takes care of leisure. The supporters of the living wage argue that living wage promotes social sustainability and unity. By promising a standard of living, more people will have increased social mobility. and it will eventually reduce the gap between the rich and the poor. For shifting from minimum wage to living wage, the state has to be sensitive about the socio-economic nuances of each part of the country to reach a suitable living wage. If implemented, the living wage may pose a few challenges too. It will put a burden on the government exchequer. Private companies too will have to shell out more money, and they may resort to job cuts.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The living wage isn't a new concept. A workers' union in the US had proposed a general living wage to maintain a standard of living in 19th century. They wanted the wages to be at par with European workers. That's all for today. Catch the next episode of the morning show tomorrow. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.